Let me tell you about the $50,000 mistake that you can avoid. Sarah graduated college 5 years ago with $50,000 in student loans. She's been making her payments religiously every month. So how much does she owe today? $75,000. That's right, after 5 years of payments, she owes $25,000 more than when she started. This isn't a mistake. This isn't bad luck. Student loans are designed to trap you. They're built with 4 specific mechanisms that make escape nearly impossible. And today, I'm going to show you exactly how they work.
Here's something that might shock you. Student loans are the only debt in America that you can't escape through bankruptcy. Credit cards? Gone. Mortgage? Dischargeable. Gambling debts? Yep, those too. Medical bills from a catastrophic illness? Bankruptcy can wipe them clean. But student loans? They follow you to the grave. This wasn't always the case. Back in the 1970s, you could discharge student loans in bankruptcy just like any other debt. But in 1976, Congress changed the rules. They said you had to wait 5 years after graduation before you could discharge them. Then it became 7 years, then 10 years. In 2005, they eliminated the option entirely for most borrowers. Now, if you want to discharge student loans in bankruptcy, you have to pass something called the Brunner test. You need to prove 3 things. First, that you can't maintain a minimal standard of living while paying your loans. Second, that your financial situation is likely to persist for the entire life of the loan. And third, that you've made good faith efforts to repay. These criteria are deliberately impossible to meet. The courts have ruled that being homeless doesn't automatically qualify you. Neither does having a disability. One court even ruled that a borrower who was permanently disabled and living on food stamps still didn't meet the standard. The result? Less than 1% of student loan borrowers successfully discharged their debt through bankruptcy. Your odds are literally better at winning the lottery. Compare this to credit cards. Run up $100,000 in credit card debt buying luxury items? Bankruptcy can eliminate that. Take out a mortgage you can't afford on a house you don't need? Chapter 7 can discharge the remaining balance after foreclosure. Lose money gambling in Vegas? The bankruptcy court will protect you. But borrow money to get an education? You're trapped forever. This creates a perverse incentive system. Credit card companies have to be careful about who they lend to because they might not get paid back. Mortgage lenders have to verify income and assess risk, but student loan companies, they can lend unlimited amounts to anyone because they know the debt can never be discharged. Think about what this means. If you make a mistake with any other type of debt, the legal system provides a safety net. Bankruptcy exists because sometimes people make bad financial decisions, face unexpected hardships, or simply get in over their heads. Society has decided that everyone deserves a second chance, except students. The student loan industry convinced Congress that education debt was different. They argued that people would abuse the system, take out loans, get their degree, then immediately file bankruptcy. But here's the thing, that almost never happened. Even when student loans were dischargeable, discharge rates were incredibly low. Students weren't gaming the system, but the industry used this fear to eliminate the safety net entirely. Now, think about the psychology this creates. When you know there's no escape, when you know the debt will follow you forever, you become desperate. You'll accept any payment plan, any terms, any arrangement that promises relief, even if that arrangement makes your situation worse. And that's exactly what the other 3 traps are designed to do. The bankruptcy protection doesn't just eliminate your legal options, it eliminates your negotiating power. Credit card companies will settle debts for pennies on the dollar because they know you can walk away. Student loan companies don't have to negotiate because they know you can't leave. This is why student loan debt has exploded over the past 30 years. When lenders face no risk of loss, they have no incentive to lend responsibly. When borrowers have no escape route, they have no leverage to demand better terms. The bankruptcy lie isn't just about legal technicalities. It's the foundation that makes all the other traps possible. Without the threat of discharge, lenders can design repayment systems that maximize their profits while keeping borrowers trapped in debt forever. But that's just the beginning of the trap.
Now, here's where the math gets really ugly. Even if you could discharge student loans in bankruptcy, most borrowers would never get that far because of how interest capitalization works. Let's start with a simple example. You borrow $30,000 for college at 6% interest. Sounds manageable, right? But here's what they don't tell you. That interest starts accumulating the moment you take out the loan, not when you graduate. During your 4 years in school, that $30,000 is quietly growing. At 6% annual interest, you're adding about $1,800 in interest every year. By the time you graduate, your $30,000 loan has become $37,200. You haven't made a single payment, and you already owe $7,200 more than you borrowed. But it gets worse. When you graduate, something called capitalization happens. All that accumulated interest gets added to your principal balance. So now your loan isn't $30,000 anymore. It's $37,200. And that's the number your future payments are calculated on. This is compound interest in reverse. Instead of working for you, it's working against you. And unlike compound interest in investments, which can take years to show dramatic results, student loan interest compounds immediately and relentlessly. Here's how the math works. Let's say you have that $37,200 balance when you graduate. At 6% interest, you're now paying interest on the interest that accumulated while you were in school. Your monthly interest charge isn't based on the original $30,000. It's based on $37,200. That means you're paying an extra $432 per year in interest just on the capitalized amount. Over a 10-year repayment period, that's an extra $4,320. The interest on the interest cost you more than an entire year's tuition at many community colleges. Now, let's talk about the capitalization trigger points. Interest capitalizes when you graduate, but that's not the only time. It also capitalizes when you enter forbearance, when you exit forbearance, when you switch repayment plans, and when you consolidate loans. Each time this happens, any unpaid interest gets added to your principal balance. And once it's added, you pay interest on that amount for the rest of the loan's life. This creates what I call the grace period illusion. After graduation, you get a 6-month grace period before payments start. Sounds generous, right? But during those 6 months, interest keeps accumulating. At graduation, you might owe $37,200. By the time your first payment is due, you could owe $39,000 or more. Many borrowers don't understand this. They think the grace period means the loan is on pause. But the loan is never on pause. The interest never stops. Then there's the forbearance trap. Life happens. You lose your job, face a medical emergency, or just can't make the payments. Your loan servicer offers forbearance, temporary relief from payments. Sounds like a lifeline. But forbearance is often a trap disguised as help. While your payments stop, the interest doesn't. It keeps accumulating every single day. And when the forbearance ends, all that accumulated interest capitalizes. Let's say you have a $50,000 balance at 6% interest and you enter forbearance for 1 year. During that year, you'll accumulate $3,000 in interest. When forbearance ends, your balance becomes $53,000. Your monthly interest charge, which was calculated on $50,000, is now inadequate to even cover the interest on $53,000. This is how borrowers end up in negative amortization without even knowing it. They think they're getting help, but they're actually digging themselves deeper into debt. I've seen cases where borrowers enter forbearance with a $40,000 balance and emerge with a $45,000 balance, even though they never borrowed another penny. The interest alone grew by $5,000 while they were supposedly getting help. The insidious part is how this compounds over time. Every forbearance, every deferment, every capitalization event makes the problem worse. The balance grows, the monthly interest charges increase, and the borrower falls further behind. This is exactly what happened to Sarah from our opening example. She didn't miss payments, she didn't default, she used the help programs her loan servicer offered, and every time she did, capitalization made her debt bigger. Now, here's where it gets really insidious. The government knows the standard repayment plans are crushing borrowers, so they created Income-Driven Repayment Plans, or IDR. These plans sound like the solution: lower monthly payments based on your income and loan forgiveness after 20 or 25 years. Here's the problem. IDR plans often make your debt bigger, not smaller. Let's break down the math. You have $50,000 in student loans at 6% interest. Under the standard 10-year plan, your monthly payment would be about $555. That's tough, but you'd pay off the loan completely in 10 years for a total cost of around $66,600. Now let's say you can't afford $555, so you switch to an IDR plan. Based on your income, your new payment is $300 per month. Sounds better, right? Here's what they don't tell you. At 6% interest, your $50,000 balance generates $250 in interest every month. So when you pay $300, only $50 goes toward reducing your actual debt. You're barely making progress. But it gets worse. If your income is low enough, your IDR payment might not even cover the monthly interest. Let's say your payment is only $200. You're paying $200, but $250 in interest is accumulating. Your balance actually grows by $50 every month, even though you're making payments. This is called negative amortization. You're making payments, but your debt is getting bigger. After 5 years of $200 monthly payments, you've paid $12,000, but your loan balance has grown from $50,000 to $53,000. You paid $12,000 and now owe $3,000 more than when you started. This is exactly what happened to Sarah. The IDR system creates a generation of permanent debtors. Instead of paying off loans in 10 years, borrowers are locked into 20 or 25-year repayment periods. That's longer than most mortgages. Think about what this means for your life. You take out student loans at 18. Under IDR, you're still paying them off at 43. You could have a mortgage, car payments, and kids in college while still paying for your own education from 25 years ago. But here's the cruelest part, the tax bomb. After 20 or 25 years of payments, any remaining balance gets forgiven. Sounds great, until you learn that forgiven debt counts as taxable income. Let's say you started with $50,000 in loans. After 25 years of IDR payments, your balance has grown to $80,000 due to negative amortization. When that $80,000 gets forgiven, the IRS treats it as if you earned $80,000 in income that year. If you're in the 22% tax bracket, you suddenly owe $17,600 in taxes on forgiven student loan debt. The government forgives your loan, then immediately sends you a tax bill for nearly $18,000. Most borrowers have no idea this is coming. They spend 25 years thinking they're working toward forgiveness, only to discover they owe the IRS a massive lump sum they can't afford. The recent SAVE plan was supposed to fix some of these problems. It promised lower payments and faster forgiveness, but even SAVE doesn't eliminate negative amortization for many borrowers, and the tax bomb? Still there.
The system is rigged against you, but that doesn't mean you're powerless. There are specific strategies that can help you escape the trap, but they require discipline and understanding how the game actually works. First, aggressive payment strategy. If you can afford it, pay more than the minimum every month. Even an extra $50 can make a massive difference over time. Here's why. Every extra dollar goes directly toward principal, not interest. When you reduce principal, you reduce the amount that generates interest next month. Let's say you have a $40,000 loan at 6% interest with a minimum payment of $444. If you pay exactly the minimum, you'll pay $53,280 total over 10 years. But if you add just $100 extra each month, you'll pay off the loan in 7 years for a total of $45,600. That extra $100 per month saves you $7,680 and 3 years of payments. The key is targeting your highest interest rate loans first. This is called the Avalanche Method. List all your loans by interest rate, highest to lowest. Make minimum payments on everything, but put every extra dollar toward the highest rate loan. Once that's paid off, move to the next highest rate. This saves you more money than paying off small balances first, even though it might feel less satisfying. Math beats psychology when you're trying to escape debt.
Avoid forbearance and deferment unless you absolutely have no other choice. Remember, interest never stops accumulating. If you're struggling, contact your servicer about switching to an IDR plan instead. At least with IDR, you're making some payment toward the debt. If you're already on an IDR plan, understand which one you're using. Not all IDR plans are created equal. The newest SAVE plan offers better terms than older plans like IBR or PAYE. But even SAVE can trap you in negative amortization if your payments are too low. Here's the critical calculation. If your monthly IDR payment is less than the monthly interest on your loans, you're in negative amortization. Your debt will grow, not shrink. In that case, try to pay at least enough to cover the monthly interest, even if it's more than your calculated IDR payment. Refinancing is tempting because private lenders often offer lower interest rates. But be careful. When you refinance federal loans with a private lender, you lose all federal protections. No more IDR plans, no forbearance options, and definitely no forgiveness programs. Only consider refinancing if you have stable income, excellent credit, and can get a significantly lower rate. And never refinance more than you can afford to pay off quickly. Employment-based forgiveness programs can work, but they're extremely limited. Public service loan forgiveness requires working for qualifying employers for 10 years while making qualifying payments. Teacher loan forgiveness offers up to $17,500 forgiveness after 5 years of teaching in low-income schools. These programs have strict requirements and high rejection rates. Don't count on forgiveness as your primary strategy. Recent policy changes have made some improvements. The SAVE plan offers lower payments and faster forgiveness timelines. Some borrowers with small original balances can now get forgiveness after just 10 years. But these changes don't fix the fundamental problems with the system. Student loans aren't just debt. They're uniquely dangerous debt designed to trap borrowers in a system that profits from their inability to escape. If you want more straightforward breakdowns of how money actually works, hit that subscribe button.